Whenever we talk about assets, it's important to talk about depreciation, and in the case of intangible assets, amortization. Before we begin our exercises in QuickBooks, let's do a little work on terminology. First, depreciation. Depreciation takes into account the wear and tear on assets which are used over the long term. What we're really doing here is spreading the cost of the asset over the true period of time in which we're using them. Let's take a vehicle for instance. I spend $10,000 on a truck. I intend to use it for 5 years. It really wouldn't be fair to take the entire $10,000 and expense it out this year. So what I can do through depreciation is actually expense out $2,000 for 5 years. That way I've equally spread the cost of the vehicle during the time in which I'm using it. With depreciation, we handle this costing aspect through a special contra account called accumulated depreciation. Now, depreciation applies to all capital assets. It's a non-cash transaction, no money's changing hands, just an accounting entry, but it has major tax implications. Now, when we say a capital asset, we're referring to anything that hits our balance sheet. Exactly what we will put on the balance sheet is determined by our internal procedures. For instance, typically it is anything that is going to be used over 1 year and over a certain dollar amount. Now traditionally this is right around $1,000. However, every company can have a different level in here. The key to depreciation is that I'm going to book the cost of the vehicle as an expense over the course of the period of time. But no money's changing hands. I already purchased the vehicle via a loan or via cash. When applying depreciation, first what we do is determine the value of the asset. Next, the expected useful life of the asset, and finally, a depreciation method. Now both the expected life and the depreciation method are determined by the IRS. So truthfully, we'll refer to a book, or we'll commonly call our accountant and ask them how we should depreciate each individual item. In the case of intangible assets, we will do the same thing. However, we tend to refer to this as amortization. Here, items such as trademarks, copyrights, and other intellectual property that are intangible, in other words, I do not have anything solid that I can pick up in my hands, we will also cost out. We just change the terminology to amortization. By the way, when we use the term goodwill, goodwill refers to when we purchase a business and we give a section of the fees to the establishment of that business. For instance, if you purchased my business, I have a customer base already established. I've been in business for 20 years. That customer base definitely has some value to it. It's an intangible asset though. There's nothing you can touch or feel, but it's the value of what that customer base is to the business. When I put a dollar amount on it, I will then consider it to be goodwill. Goodwill is an example of an intangible asset.